Hi. And welcome to Financial Planning with Michael Feltman, and your guide to understanding South African tax. This is an episode-based series, where I will be walking through all of the confusing elements of tax, and explaining them. In today's episode we will be discussing gross income, and its importance in the income tax calculation, namely, how to determine what forms part of gross income, and how to calculate gross income. Well, time is money, so let's start. You will recall, the framework for the income calculation is gross income. This is your basic pay on your payslip, for example. We then less deductions. This is where your pension fund contributions, pay as you earn, and unemployment fund contributions would take place. We then add any taxable capital gain, such as growth in shares. This then gives us our taxable income. This is where we apply the tax table calculation. This gives us the tax amount. We then less the tax amount with the tax rebate. SARS allows a rebate on all individuals. At last, we then have tax payable. If you look at the aforementioned formula, you will observe that gross income is the very first amount that we need to input. Gross income is anything of a revenue nature received by, or accrued, in cash or otherwise. It also includes special inclusions. The specific inclusion provisions ensure that certain amounts received by or accrued to a taxpayer are included in gross income, even though they may be regarded as capital in nature. They are specifically included in gross income, because they are indirectly or directly linked to employment or result from services rendered. From episode 1, we know that what forms part of gross income is mainly determined by the definition of gross income in the Act. Furthermore, we know the definition assists in distinguishing between gross income and capital. When doing so, special inclusions must be borne in mind. Therefore, the process to determine whether an amount constitutes gross income, whether it is of a capital nature, consider the following. Firstly, has the amount been received or accrued? If no, then there is no need to proceed, as it is neither gross income nor capital in nature. If yes, then we need to consider whether it may be a capital receipt or accrual. If it's neither a capital receipt nor accrual, then you will include it in gross income. If it is a capital receipt or accrual, then you need to consider whether it's a specific inclusion. If it's not a special inclusion, then there's no gross income. If it is a special inclusion, then it will form part of gross income. The specific inclusion provisions, as set out in the gross income definition, include, amongst others, the following. Firstly, annuities. This does not include payments received from employment as a result of life insurance taken out by the employer on the life of the employee. Maintenance. Payments in respect of services rendered, such as leave pay, bonuses, even voluntary awards. Restraint of trade payments. Lump sums from the termination of employment, paid by the employer, either directly or via a life insurance policy. This paragraph does not include lump sums from a retirement fund. Lump sums from pension, provident, preservation and retirement annuity funds. Any amount received or accrued, in commutation of amounts due, under any contract of employment or service, for example, leave pay. Fringe benefits arising from employment. Dividends, local and foreign. Amounts from employer-owned insurance policies, such as Keyman insurance, received by employer. Other inclusions in income, and recovery of expenses previously claimed as a tax deduction. Let us supply all of the information we currently have, to an example. Mr. and Mrs. X are married out of community of property. During the 2019-2020 year of assessment, Mr. X, aged 50, earned the following income. Salary of R300,000. UK commission of R45,000. Interest of R22,000. Equity unit trust dividends of R2,000. Rental income of R30,000. Mr. X's salary is 70% pension funding and he contributes 7.5% of the pension funding portion of his salary to a pension fund. There are no employer contributions. Together Mr. and Mrs. X own a cottage which they rent to students. During the year they have spent £4,000 on painting the cottage. Mr. X received commission from a company based in London and spent 180 days living in London earning this income. The commission is not considered for purposes of pension fund contributions. Mr. X sold his holiday home and shares during the 2018-2019 tax year. The selling price of the holiday home was £3 million and the worth of the shares was £100,000. The house was mainly used for holiday purposes. The base cost of the house is £700,000 and the base cost of the shares is £150,000. He had held the shares for less than 3 years and then traded them in. The shares were not held for long-term investment purposes. A capital loss during the previous tax year amounts to £20,000. Let us calculate Mr. X's gross income for the year. As per the definition of gross income, the following forms part of gross income. Mr. X's salary of £300,000, as this is an amount in cash, received by a resident, for services rendered. As Mr. X is a South African resident, he is taxed on his worldwide income, and the UK Commission forms part of his gross income, as it is an amount in cash received by a resident for services rendered. Interest of £22,000, as this is an amount in cash received by such resident. Equity unit trust dividends of £2,000, as this is a special inclusion. Rental income of £30,000, because this is an amount in cash received by a resident. The sale of shares of £100,000, because this will be deemed to be trading stock, even though there is a loss in value. Please see episode 1, for an explanation of the golden rule of intention. The holiday home will not be included, as it was never Mr. X's intention to sell the home and make a profit, but rather to mainly use it for holiday purposes. All of the above equals £499,000 in gross income. Mr. Williams, who is 67 years of age, is married in community of property, and receives the following amounts during the 2019-2020 year of assessment. Commission on the sale of vehicles £100,000. Rent on flat £10,000. Interest £10,000. Offshore dividends £2,000. He contributes £15,900 per year to a retirement annuity. His medical costs for the year of assessment amount to £30,000. Assume Mr. Williams retires at the end of this year of assessment. The total value of his retirement interest in the fund is £2,700,000. He commutes 1/3, for a lump sum of £900,000. A total amount of £150,000 of his contributions to the fund was not allowed as a tax deduction. He has not received any previous retirement withdrawal or retirement lump sum benefits. So, let us calculate his gross income. As a result of his marital regime being in community of property, all passive income is split with his wife. Therefore, £5,000, 50%, rent on his flat will be included. £5,000, 50%, interest will be included. Offshore dividends of £1,000, 50%, will be included. His commission of £100,000 will form part of gross income. Trade income, or income as a result of past trade, is normally not split between spouses, nor are annuities from past membership of retirement funds, as this is still considered to be income from trade. Although rental income is regarded to be income from trade, it is specifically excluded, and must accordingly be split between the spouses. The retirement full lump sum amount is £2,700,000, of which only 1/3 is commuted. However, £150,000 worth of contributions were previously disallowed. This can now be deducted off the amount to be taxed, and included in gross income. Therefore £900,000, less £150,000, equals £750,000. Therefore, the total gross income is £861,000. That's it for today's episode, and I hope that it has helped in some way. Thank you so much for watching. Please stay tuned for further episodes by subscribing to my channel. Don't forget to like. Cheers.